Hi, this is Rob Wilson from Instant Trading Results, and today I'm going to teach you all about the incredible power of stock options. But first off, I need to read you this disclaimer. Unique experiences and past performance of anything discussed or demonstrated today is not guaranteed and may not indicate future results. Examples are non-representative of all trades. Certain trades may have substantially worse performance than indicated. All markets have inherent risk, and there is always the potential for loss. Today's lessons are for educational purposes only. Now, I do not have a financial services license, nor am I licensed to give personal financial advice. So again, today's lessons are for educational purposes only. Okay, now that we've got that completed, let's get into it. My objective today is to give you a better understanding of how to trade options. This will enable you to stack the odds in your favour to become a consistently profitable trader. When you learn how to trade options, you will never buy another stock again. When you learn how to be an option seller, you will never buy another option again. So my main goal today is for you to learn how to be an options seller. So what are options? Well, they're really quite simple actually. Because there are only two. There's a call option and there's a put option. Now, an option gives you the right to buy or sell a certain stock at a certain price by a certain time. Now, many people think that options really are complicated, but they're not. So I'm going to break it all down into tiny bite-sized pieces so then it will be simple for you as well. So to buy, the right to buy. So then you would buy a call option. And the right to sell is a put option. The certain stock is the underlying instrument. Now you can trade options on a lot of different things, futures and so on, but today is all about stock options. The certain price is known as the strike price. That's the price that you can buy or sell the stock at. The certain time is the expiration date. See, options expire. You have an option to buy or sell them by a certain time. That's the expiration date. An option contract controls 100 shares of stock. So if you buy a call option, you're then getting the rights to buy 100 shares of stock. If you get 10 options, well then that's giving you the rights to 1,000 shares of stock. Now, monthly option contracts expire on the third Friday of the month. And there's also weekly option contracts too, and they expire on Fridays. I prefer to trade the monthly option contracts because there's a lot more volume, more action in the monthly contracts. So why do people trade options? Well, quite obviously, to make money. They can give you instantaneous income. Money can go into your account immediately. Or two, some people like residual income, to get an ongoing residual income. And the third is to be able to leverage your money, to give you a bigger bang for your buck. So leverage, imagine controlling a $50 stock for only $5. I'll teach you shortly how all that works, but just think of that for one moment. If you could control a $50 stock for only $5, so instead of outlaying $50, you're only outlaying $5. If that $50 stock went up $1, you'd make a 2% return. Now, if the $5 option could go up, say, only 50 cents, that actually equates to a 10% return. So options give you the absolute biggest bang for your buck. Why else do people trade options? Well, they can hedge your stock portfolio. Put options can be purchased to hedge stock portfolios. They protect the downside risk of owning stocks because they increase in value when the underlying stock decreases. A lot of hedge funds, for example, will go and buy millions or billions of dollars worth of stocks, and then they'll go and buy put options to protect their portfolio in case those stocks go down. Well, you can do the same too by buying put options. Option premiums. The premium is the actual cost of the option. So an option buyer pays the premium, while the option seller, that's also known as the writer, they receive the premium. Now remember earlier, I told you that I would like to teach you how to be an option seller and not a buyer. So there's a little clue on the screen right now why. We'll get into that in a lot more detail shortly. There are three things that affect an options premium. Firstly, direction. Right, the direction of the stock affects the premium. Time, how long until the option expires, that affects the premium. And volatility, how much stock's going up or down all the time, that affects the premium. Now the option premium is made up of two components. Very, very important to learn this. The two components are the intrinsic value and the time value. Okay, intrinsic value and time value. Now intrinsic value, that's the difference between the option strike price and the stock price. For example, if the stock is trading at $53 and you buy the $50 call, the intrinsic value is $3. See, 53 for the stock, 50 for the call is $3 of intrinsic value. Another way of thinking that is real value. So if you've got the rights to buy something at $50 and yet it's 53 in the marketplace, there's $3 in that. $3 of real value, $3 of intrinsic value. Now time value, that's the difference between the option premium and the intrinsic value. For example, if the option premium is $5, and as per the last example, we said the intrinsic value is $3, well then of course the time value has to be $2. $5 minus $3 is time value. So you're paying $2 for the rights to buy or sell the stock by a certain period of time. You're paying for that time. Time decay. Now, an option loses 1/3 of its value in the first 2/3 of its life, and 2/3 of its value in the last third of its life. Remember I just said to you just a moment ago that you are paying for that time. You're paying for the time to decide if you want to buy or sell that stock. Okay, so the longer the period of time, the more time value. The shorter the period of time, the less time value. And as you can see on the screen there, you can see how in the last part of the option's life, there's time decay, it just falls off the edge of the cliff. An option chain. Okay, that's what you're seeing on the screen now is an option chain. Now, if we look at up the top there, we can see it's an option chain of Microsoft. And look at number 2 down the middle. They're the strike prices. They're the different prices that you can buy or sell Microsoft at. Okay, look at those in the middle there, $17, $18, $19. Wow. So I've been teaching options for 20 odd years. So this is an old screenshot that I've included on there. Yes, Microsoft was around $18 at one stage. Now, look at number 2 is the strike. Number 3, we can see the bid and the ask. So the red highlighted area is there. Okay, just in here is 109, 110. So a good thing to remember here is which one. Which do we buy? Which one are we selling? Are we buying the bid or are we buying the ask? Well, the easiest way to remember is that when you buy something, it's going to cost you the most. So if we're going to buy it, you're going to be buying at the ask, $1.10. And when we want to sell something, we're going to get the worst price. So we're only going to get $1.09, not $1.10. So when we're selling, we get the bid price. Now the difference between those two, 109 and 110, that's what the market makers make. They make the market out of this, so they pick up the difference between the bid and the ask. Now here, the next one, let's go to number 4 then in sequence, is open interest. And then number 5 is the volume. As we say down the bottom, volume is the number of contracts traded, and open interest is the number of contracts available to be traded. So there's a little clue when you see those numbers. We want to be where the action is. There's no point being there where there's only 1 or 2 or 3 options trading. We want to be able to get there and make sure we can get in and out of our trades. Calls, puts, and their outlooks. So let's look a little bit deeper into calls and puts. Now, when you're buying a call, so in other words, you're going long. When you buy a call, you are bullish. You think the stock will be worth more later. So you want to lock in today's price to buy later at a profit. For example, let's say a stock is trading at $20 and you think it's going to go up. You could buy a $20 call for say $1 to lock in the price to buy it at a later date for a profit. So buying options, money out. Right? It costs you money to buy options. Now pay attention to that. When you buy options, money is going out. That's a clue to what we're going to get to shortly. So if the stock goes up to $25, you've just bought the rights to buy it at $20. So therefore you're going to make $4 per share. Right? How do we get that? Well, the option was 20, the stock is 25. There's a $5 difference there. Okay, so you've made $5, but you've only net $4 because it cost you $1 for that option. So you've outlaid $1 and you've made $4. That's not a bad return, is it? A lot better than outlaying $20 to return $25. Selling a call, that's going short. It's bearish, right? If you sell a call, you think that the stock will be worth less later. So you want to lock in today's price to sell later at a profit. So we can buy calls or we can sell calls. For example, let's say a stock is trading at $20 and you think it's going to go down. You could sell a $20 call for $1 to lock in the price to sell it later at a profit. Selling options, money in. You got that? When you sell options or write them, as I mentioned earlier, that's another name for them, writing options. If you write an option, money comes into your account. If the stock goes down to say $15, you have the rights to sell it at $20. Therefore, you are making $4 per share. Same as the previous example. $5 a profit minus the $1 for the option is going to give you there the $4 of profit. So we can buy calls or we can sell or write calls. What about puts? Buying a put, short. It's bearish. You think the stock will be worth less later. So you want to lock in today's price to sell later at a profit. For example, let's say a stock is trading at $20 and you think it's going to go down. You could buy a $20 put for $1 to lock in the price to sell it later at a profit. Buying options, money out. It costs you money to buy options. If the stock goes down to say $15, you have the right to sell it for $20, therefore making $4 per share, $5 minus the $1. Selling a put, long, it's bullish. You think the stock will be worth more later, so you want to lock in today's price to buy later at a profit. For example, let's say a stock is trading at $20 and you think it's going to go up. You could sell a $20 put for $1 to lock in the price to buy it later at a profit. Selling options, money in. That's what we want, guys. We want money coming into our account by selling options. If the stock goes up to $25, you have the right to buy it for $20, therefore making $4 per share. That's $5 minus $1. Now, there are two sides to every trade. Every options trade, whether it's a call or a put, has to have both a buyer of that call or put and a seller or the writer of that call or put. As you can see on the diagram there, the buyer pays the premium and the premium goes over to the seller. And the seller is giving the buyer the rights. They got the rights to control that stock. So let's have a look at rights versus obligations. Buying options versus selling options. So let's have a look at buying. When buying calls, you have the right to buy a security at a specific price. In this case, stocks. If we're going to be selling calls, when selling calls, you have the obligation to sell a security at a specified price. Big difference here, guys. When you buy, you have the rights, but not the obligation. So if you don't want to buy later, you don't have to. But selling, you have the obligation. On puts, it's the flip side of that. When buying puts, you have the rights to sell a security at a specified price. So it's a rights. But when you're selling, if you're selling puts, you have the obligation to buy a security at a specified price. So selling calls is very dangerous as you have unlimited risk. Why is it unlimited? Well, how high can a stock go up? Stock might be $5 and it could skyrocket to what? So there is infinite, unlimited risk on selling calls. While selling puts is very dangerous too, as you have unlimited risk. How low can a stock go down? Well, it's not really unlimited, is it? It's limited to zero. So I guess on both of these, we shouldn't really say unlimited risk. We should say undefined risk, because we don't know how high up the stock could go, or we don't know how low it could go. So a moment ago, I was telling you that the best option is to sell or write options because it brings money into your account. And now you're probably thinking, wow, if this risk is undefined, why on earth would this guy be telling me, selling options is the way to go? Well, I'm going to show you shortly how to mitigate those risks. And that's all in the strategies that I'm going to teach you in future videos. In, out, and at the money. So let's have a look at a $50 call option on a stock. So this is on a call. Look on the left-hand side here. You can see the strike price at $50. So if the stock is below the strike price here, you're going to be out of the money. Okay, if it's higher, then you're going to be in the money. So let's look at that a little bit deeper. At the money on call options. The stock price is around the same price as the option strike price. That is then known as at the money. Okay, $20 at the money is going to be around the $20 strike price. The stock price is above the option strike price is known as in the money. So if the stock is trading at, say, $17.50, it's going to be in the money. It's going to be $2.50 in the money. Out of the money call options. That's if the stock price is below the option strike price. Okay, so $22.50 as an example, that strike price is out of the money. So let's think of this for a moment. If the stock's trading at $20, and you've got the $17.50 strike, that's $2.50 in the money. So if you've got the rights to go and buy it at $17.50 and then go and sell it straight away in the marketplace at $20, you've just made $2.50. So you're in the money. On the flip side, out of the money, what does that mean? It means you are out of money. You don't want to go and buy a stock that's $22.50 if you could go and buy it in the marketplace for $20. So just think of in the money or out of the money. So in call options, you can see that on the chart there. In the money, out of the money, at the money, $429 at the money. If the price is higher, that's out of the money. If it's lower, it is in the money on a call option. So in, out, and at the money on the put option, exactly the same, except it's opposite. So in this case, the strike price is $50. So if the stock is below $50, you are in the money. If it's above, you are out of the money. So at the money on put options, the stock price is around the same price as the option strike price. So a $20 stock, somewhere around $20 is going to be at the money. In the money is if the stock price is below the option price. Out of the money is if the stock price is going to be above the option price. So here on the chart, we can see at the money at 429 again, and for put options, in the money is going to be above, and out of the money is going to be below. Now in, out, and at the money, $50 call is the right to buy the stock at $50. So let's say it goes up. All right, stock goes up to $60. You're then in the money. Woohoo! We're in the money. We have a profit of $10 per share. See, the stock's gone up from 50 to 60. Now, if the stock goes down to, say, $40, well, then we're out of money. We've just lost $10 per share. On the flip side of that, a put, $50, we've got the rights to sell it at $50. So if the stock goes up to, say, 60, we're out of money. All right, so we've just lost $10. All right, the stock's worth $60. You don't want to put that stock to somebody for $50 because you've just lost $10. Now, if the stock goes down to, say, $40, well, now we're in the money. We've just profited. We've just made $10 per share. The option chain. We had a look at a chain earlier on. Let's have a look at it here again now. So we can see here that the stock is around $151. So around 151, 52 is going to be at the money. Okay, then we can see in the money here for calls, and we can see out of the money here for calls. We can see in the money for puts, and we can see out of the money for puts. Now, a strange thing we're going to see here in the middle with our options chain, and this is something that we have to get used to with our options, is see how those prices are going up, but the chart is going down. That's how they are displayed on an option chain. Yes, it messes with your head a little bit at first because you think, why isn't it going here 150, 151, 152? Why is it going down? It's just a peculiar thing with an options chain. So what can a market do? Okay, options is all about probabilities, and we need to analyze this, and this is really, really cool to work out what strategy we want to do, because we want to stack as many odds to our favor to enable us to get the biggest bang for our buck. So what can a market do? It could go up. Okay, it's got around 33.33% chance of happening. It could go down. Again, 33% chance of happening. Or it could stay sideways, a 33% chance of happening. Only three things could happen, couldn't it? So what can you do with options? And I'll come back to that last screen in a moment. So what we can do with options can be bought, they can be sold, or written. Bought, the purchaser has unlimited profit potential. The purchaser's risk is limited to only the premium that they've paid. That's the only risk, is whatever you pay for the premium, that is the maximum you can lose on that trade. Now, to open a bought position, you buy to open. And when you go to close that bought position, you sell to close. So bought calls as an example. It's the bullish strategy. The purchaser has the right, but not the obligation, to buy the stock at the strike price on or before the expiration date. You've got unlimited profit potential if the stock goes up, but you only have limited losses if the stock stays flat or goes down. The chances of this trade being profitable is 33.33%. Remember, stock can only go up, down, or sideways. One of those three things it can do. And here, when you're buying options, your maximum risk, your maximum that you could lose, is whatever you pay for that premium. Now, bought puts, that's the bearish strategy. The purchaser has the right, but not the obligation, to sell the stock at the strike price on or before the expiration date. So the profit potential is not really unlimited now. It's limited to zero if the stock goes down. So the more the stock goes down, the more you're going to make on this strategy. And it has limited losses if the stock stays flat or goes up. The maximum you can lose with buying an option is the premium you pay. Now, the chances of this trade being profitable is, again, 33.33%. Now, what can we do with options? Options can be bought, they can be sold, or they can be written. Now, let's have a look at written now. Right? What's the difference with that compared with buying? Well, remember before where we said there's two sides to every trade. There's the buyer and the seller. The seller is writing that option contract. So here in this case, we're the writer. The writer has limited profit potential. The writer's risk is unlimited with calls. Why is it unlimited? Well, how high can a call go? How high can a stock go? The writer's risk is limited on a put. It's limited to the stock going down to zero. Now, to open a written position, we sell to open. To close a written position, we buy to close. Written calls is a bearish strategy. The writer has the obligation to sell the stock at the strike price on or before the expiration date. The limited profit potential if the stock goes down or stays at the same price. In other words, it trades flat. Have unlimited losses if the stock goes up. Now, the chances of this trade being profitable is 66.6% because of those two things. Okay? Because if the stock goes down or if the stock stays sideways. So you can win 2 out of 3 ways with this. Now, written puts is a bullish strategy. The writer has the obligation to buy the stock at the strike price on or before the expiration date. So it's limited profit potential if the stock goes up or stays flat. Losses limited to zero if the stock goes down. Okay, so losses are getting bigger and bigger and bigger as the stock goes down. The chances of this trade being profitable is again 66.66%. Okay, 2 out of 3 things can happen for this trade to be profitable. So buying versus writing. 2 big reasons why we write options instead of buying them. Number 1, the probability of market direction is 66%. So you've got 2 ways of making money with this. Okay, if the stock goes the direction you think it's going to go, or it stays flat. So you've got 2 out of 3 possibilities of making money. Number 2 is very important as well. Over 80% of options expire worthless. See, a lot of people think options are dangerous and you can lose so much money with trading options. And there's been so many horror stories about people losing money trading options. Well, I wonder if they're the buyer or if they're the writer. Because think of that for a moment. If an option has 80% chance of expiring worthless, why on earth would you buy it? If you were going to be a collector of anything else, okay, you're going to go and buy art or you're going to go and buy whatever, something to collect, you're wanting the price to go up, aren't you? Okay, why would you ever collect something that has an 80% chance of being worthless? Just doesn't make sense, does it? So with these odds, doesn't it make sense to be an option seller instead of an option buyer? So buying options is directional trading. It is the most difficult form of trading as you have to predict the direction of the stock. Now, I'm sure we all know that there is no logic in the stock market. A company can go and give fantastic earnings and say, we've just made so much money and we think the next quarter we're going to make so much more. Logic would say that that stock would go up. But how many times have we seen the stock go down? And on the flip side of that, a company could give out earnings and say, we've had a terrible quarter. We've lost so much money. And next quarter, we've got no idea where the money's going to come from. And some of those stocks go up. It just doesn't make sense. So being an option seller is the way to go, not being an option buyer, because directional trading is so difficult. Let's have a look at the premium, and then we'll see why selling it works. We want to sell the premium. So here are some results from our broker of selling every 5 days for the past 5 years. This is using the SPY. Okay, percentage of winners. Have a look at this. Buying strangles at expiration compared with selling strangles at expiration. Now, I'm not going to go into what this strategy is, all right, but just look at this here, buying and selling. I talk about the strategy and teach you everything about the strategy in another video, but I just want you to look at this part here. Forget the strategy. We're just looking at buying and selling. So buying, percentage of winners, 17%. Percentage of winners of selling it, okay, 83%. Remember I said before, there's a buyer and a seller in every transaction. What would you want to be? You want to be the buyer or you want to be the seller? The average trade, buying, lost $77. So the seller, of course, made $77. The average winner here was $208 on buying. Now on selling, didn't make as much as an average winner. It was $131. The average loser was only $131 as the buyer. But the seller had a higher loss, had $208. But look at our max win per loss. Okay, $1,100 to $499, $499 to $1,100. But the bottom line here, guys, is this one, the total P&L. Over all of those trades, the buyer lost over $20,000, while the seller or the writer made over $20,000. What do you want to be? Do you want to be the buyer or do you want to be the writer? Well, let me ask you another question. Are you in this to make money or are you in this to lose money? Support and resistance. This is the technical analysis part of our trading. This is the only technical analysis that I really look at, is support and resistance. So pay attention to this. It's very important for when we go to place our trades, which I teach you in in other videos, but we've got to nail all of this basic stuff first. Okay, we've got to understand all of how this basics works, and then we can put the strategies in place, applying everything we're learning here now. So support is a price level that a stock has had difficulty falling below. It's supporting it. It's holding it up. Resistance is a price level that a stock has had difficulty rising above. It resists it. It's pushing up, and it's just so hard to push up. Here on a chart, we can see our support and resistance levels here. See, the stock's going up, but it just can't push up higher. Right? It's resisting. It's pushing up, but can't get higher. Now it starts going down. Doesn't go down any lower because it's getting supported here. Goes back up again. Bam! Hits its head on resistance. Starts coming down. Then it gets protected down the bottom here on support. Okay? Comes up again. Oh, now it pushes up through resistance and starts coming back down again. Now the resistance is flipped to support because it's supporting it and holding it now. So now we have to look further up to go and find the new resistance levels. So that's our support and resistance. We want to look at the history and see where the stock has had difficulty going up above and where it's had difficulty going down below. And then we use those levels for when we apply our strategies, which I'll teach you in a future video shortly. Now, the education process. I've covered a fair bit here today, and this, I should have said right at the beginning, is the boring stuff. Okay, all this basic stuff of options, it's like, oh, in the money, out of the money, calls, puts, strikes, so on and so on. Oh, what do I have to know that for? Well, we need to nail that before we can do our strategies and apply the strategies to this. So repetition. We must watch or listen to material 5 to 7 times before we fully comprehend it. So go over this video, rewind it, go through it again, go through it again, go through it again. Let it all sink into your head, and it's totally going to be worth it, because when you implant all of this into your brain, it's going to make your strategy, your trade, so much more profitable. You have to nail this part first before you move on to the next videos. Then paper trade it. Paper trade is practice trading. Okay? Paper trade at least 10 profitable trades in a row before using real money when you learn new strategies. I'm going to be teaching you so many different strategies in all of this training, and you're going to be saying, wow, this is so cool. Oh, I want to jump in now. I want to put money in right now. What if you make a mistake? What if you place your trade at the wrong position? Right? What if you buy instead of selling? Okay, what if you do a call instead of a put? What if you put your call above the put instead of the put above the call, and you mix the strategy up? Okay, you've got to nail this first. Do at least 10 profitable trades in a row before you use real money. Perfect practice. That's what this is about. Not practice makes perfect. No. How many times have we heard that? Practice makes perfect. That's wrong. What if you've been practicing wrong? Okay, then you've perfected wrong, haven't you? Perfect practice makes perfect. That's the 3 P's of trading. That is why I want you to paper trade before you trade with real money. Perfect your practice. And think big. As long as you have to think anyway, think big. You're going to see some great returns in this training that I'm going to be giving you shortly on the different strategies. And you'll be thinking, wow, I can make more in a week, or I could make more in a month than what a bank will give me in a year. That can't be true. Well, take your blinkers off and think big, because I'm going to show you with live examples over and over and over and over again of how this stuff works. Please really pay attention to this page, rewind this now, and review this material again. Then my online trading room. It is your key to freedom. It will take you from working 60, 80 hours per week, or however many hours you're working, to only 30 minutes per day. Okay? Only 30 minutes a day, guys, to be able to manage your trades. Is it going to be worth it, where you may be able to replace or supplement your income with investing 30 minutes per day? So nail this training so you can do that. Look at the picture on the left. It's not about having 3 monitors, getting analysis paralysis. That's my job. That is me. I do have 3 in my office, okay? But it helps me to be able to help you find some great trades, and I'm going to be showing you example after example. And in our live trading room, I show you live trades that I place. So I record my trades so you can view me placing those trades in my live trading account. Then you could be like this beautiful family here, sitting on the beach, traveling the world, laptop lifestyle as they call it. It can be a reality. Now, my online trading room also has advanced training videos. So it's got advanced trading, and it also has trade alerts. Now look at that $14 note there, guys, the $14 bill. Okay, let me be your mentor. Today, you can join my trading room for only $14. It's $14 for 14 days. That's the trial. Okay, $14 to try it out. Come into the trading room, have a look. Look at the advanced training that I give you. Look at me trade. You're virtually looking over my shoulder as I'm placing the trades on my computer live in the market. There are no long-term commitments. You can cancel at any time. And I give you unlimited personal support. If for whatever reason you don't believe that you've received $14 of value during that first 14 days, just shoot me a message. You'll have access to me personally in our personal, private, exclusive Telegram group. So you'll be able to message me. You could say to me, Rob, this is not for me. No, I don't believe I got $14 of value. I'll refund you $14. The $14 is just to give it a go. All right, jump in, jump on board, and I'll see you in the members area shortly.